Hi, this is Randy Finney with the Right Side of the Chart, and this is video number 2 for Thursday, November 3rd, 2022. It's 1:34 p.m. Eastern Time as I'm starting the video, and I'll go ahead and do updates on the other items that I mentioned in that first video that I never got to, and that's Treasury bonds, crypto, and that's Bitcoin and Ethereum, crude oil, natural gas, wheat, and just kind of a general overview on commodities. I'm going to start out here with the equity markets because I've slightly tweaked my trading plan. I was from what I shared earlier, my RTY order filled, so I took a bounce trade on that, and that hit my target, and I reversed. I noticed that the Nasdaq was lagging, and so I've actually closed that out for a very small profit. And I'm short now. I'll show you why. This is ES. Now I was only trading today, came into the day short RTY, which are the small cap futures, and NQ, the Nasdaq 100 futures. But this is the S&P 500. This is only, I'm zoomed in down to a 1 month time frame. It's an hourly candle. That's that primary downtrend line that goes off the what was it, the August highs. And there was that divergent high we put in, a little whipsaw breakout, false breakout, then the trend line break, and it's been nothing but selling since. Some impulsive waves down, and you can see the S&P 500 futures have bounced back to this level. I have a couple lines here, really good. Well, it's more of a resistance zone. We're in the midpoint there, about 37.55. You can see that's that previous reaction low. You have quite a bit of resistance in there. And look, you have the divergence still on the 60-minute chart on the PPO there. RSI is about, you could call it divergence. It's about equal lows, but here's the thing. Again, Powell just kicked the market in the nuts yesterday. Again, what he said could be interpreted as nothing, in my opinion, nothing but pretty much bearish. I, like others, look, I'll trade whatever he gives me. I'll profit from a down market. I love shorting stocks, but I don't ever wish ill on the market because it then does bad things for everyone else. Most people, are relying on their 401ks. They don't know, they wouldn't know how to short to begin with, and then more so they are, conditioned buy and hold. And then of course it has bigger implications if he keeps this up. It's his thing, and he's saying it. He's going to choke the economy here. He wants to slow down demand, and that's just not going to be a good thing overall. So for the economy, it'll be fine if we'll like I say, every day the fundamental and the technical landscape changes, and I'll adjust. But I just wanted to say that based on what's happened here with the trend line break and the recent rejection off the downtrend line, and the fact that this market didn't get that pivot they were hoping for. And remember, I said it before it happened, it was priced in. Let's not forget that we had a rally, again, that was largely cited to the market's expectation that Powell may pivot. And there was a better than a 12% rally here in the S&P 500, and yet he didn't pivot. So how much of this now needs to be taken away? And so that's it. I just want to let you know that. So I'm not looking for what I might normally on a divergent low on the 60-minute chart, or even those shorter term 10-minute charts. Here's the 10-minute right there. Again, the divergences have started to play out, but the overall bigger picture on where I think we're going, it says that's probably going to be all you're going to get, or there's a good chance. They're right up to that level. There it is, 37.57. I think that's what I covered in the video anyway. So that was hit. That was the uppermost target, and maybe possible. Anything's possible, but that's it. I don't think we're going to get it here. I'm going to show you a couple others, and then we'll move on to those things that I told you I would cover. Let's see, NQ. Here's the 10-minute chart. Again, NQ's just been weak. It still has that divergence, still coming off that divergent low on the 10-minute chart, and fell shy of what I was originally targeting. But again, I decided to just turn that limit order to sell up here into a market order and just get back short. And we'll see. Maybe it proves to be the wrong thing, and then I'll make adjustments as needed. Let me give you an hourly chart there. So here's what it looks like on the 60-minute chart. Again, we have, me, I like my divergent lows, especially on the 60-minute time frame. And maybe it plays out still. You had a nice downtrend line right there. Here you can see it. a breakout, but so far they're selling into it, and it's a breakout that's likely to fail. There it is. So really, no, number one, at least as of now, no follow through buying. When you look at this 60-minute falling wedge pattern right here, you can see the breakout, and we're not going down, but we're just not going up. There's no follow through buyers right now, and maybe maybe if the market holds up, they'll start to step in and get a little emboldened, and those are still your potential targets. 10,975 and then maybe as high as 11,100. Who knows, maybe higher. The wedge would certainly project up to at least that 10,795, 975. And if we get there, then I'll be adding 2 shorts. I'm not doing anything heavy right now, but I may be soon because, again, the market's in a very precarious technical posture right now. It's not too far off those lows that it put in, the bear market lows. RTY, as I mentioned earlier, this one did hit my target. There was my bounce target right there, 17. That's why I was targeting that. So I had a order to reverse, sell the longs and go back to short just below that level. So that got hit. We're still about there right now. But then bigger picture, when you zoom out a little bit, go back a little longer, you can see we're right above that trend line. We are above it. We did recover it. But again, I'm leaning towards some more downside here. And that's pretty decent resistance we're at right there, price resistance as well. All right, last chart, and then I'll get to the things that I promised you. But again, the equity markets are, it's important. Here's what it looks like when I zoom in and look at a 60-minute chart of QQQ. What I see is a potential, this is called a bearish pennant continuation pattern. It's like a bear flag. You have 3 components. You have an impulsive move down called the flagpole, which I'm measuring here. You take the measured target, you take the length of the flagpole. I'll show you how I do that. Usually use a charting program to take a line like that and now just duplicate that line, either click to have it duplicated or just drag the line itself, put it at the highest part of the flag, and that's going to give you a measured target for that pattern if that plays out. Now, like any technical pattern, bullish or bearish, it's a potential trade pending an entry, and an entry on a bear flag continuation pattern, or in this case a bearish pennant. A flag just takes that upward shape, but the bottom of the pennant's right here, top is right there. You need a downside break, ideally impulsive. And if you want to play it safe, you can wait for a 60-minute close, a solid 60-minute close below the pattern. So that's what I'm looking at there. Now, if that does occur and it does play out for move down, let me zoom in. It's going to, where's my arrow? It would project to take us down and take out the previous lows, and that's going to be pretty bearish, and that's also going to ruin some of those potential divergences that are still in place on the daily and weekly charts. It has the potential to take those out. I showed you in the video earlier today, some of the fangs are starting to lose that divergence that they had on some of the indicators. And so where I'm going with this is I think that would be, if the flag plays down, we take out those lows, unless it's just a brief undercut and then they buy it up real hard. And I don't think that's going to happen. Anything's possible. I'll react to it, and if it does at the time. But I think we'll just keep on going down through there, and it'll be a quick move down, and we'll get kind of almost a waterfall type drop down to my next target, which again remains on QQQ around 235, 236 or something. Okay, now let's look at everything else. Treasury bonds, we're looking at TLT. This is the ETF that tracks the long bond. So you have bonds in here ranging from 20 all the way up to the 30-year Treasury bond. And we still don't have the buy signal I'm looking for. So to me, it's still a scale in. I'm keeping a position with plenty of room to add if and when we get that breakout. So we need to break out above that level on TLT, and the comparable uptrend line on the yield for the 30-year bond, which is TYX. There's your trend line right there. And so we hit it yesterday, bounced. I still think we're going to break down. Fundamental reasons is, okay, so let's look at this. So Powell is continuing to play the tough man, trying to regain credibility, afraid to waffle around. He's been wrong so much. He's put us in the mess. The Fed single-handedly Well, not single-handedly. Washington had a lot to do with it, overstimulating fiscally, and the Fed overstimulating with monetary policy way too much for way too long. Well, we all know that. That's why we're here now. But I guess he's just afraid to waffle or pivot. So he's talking the tough talk. That's not going to help the stock market. And and you might be thinking, well, Randy, why would you want to hold on to bonds? Well, here's why. So I've made the fundamental case. The long bond's gone up. We have interest rates now over 7% on mortgages. We have the 30-year Treasury bonds paying well over 4% now. Historically, it's been a flight to safety instrument. Probably the one variable or thorn in my side or thing giving me pause here and not being more aggressive is the fact the Fed's in quantitative tightening mode. They're reducing, they're running off their balance sheet, all their massive holdings of Treasury bonds and other government bonds. And that is going to be a headwind for bonds at some point, or will continue to be up until that stops. But how much of a headwind, and at what point will it be? I suspect it can be overwhelmed. The selling that the Treasury is doing, or the Fed is doing, may be overwhelmed by buying from institutions. At some point, right now, especially the stock market, the outlook for the stock market, I think it's safe to say, just went from not so hot to worst yesterday based on what Powell said, right? There's no way to spin rising rates, especially when we've seen them rise so much at the rate that they've already come up. Don't look at it and just, yeah, well, Randy, we're still historically, no. The economy was dependent, like a heroin addict. You do heroin once or twice, you might get hooked, you might want to do it again. You do it for years, and then all of a sudden go cold turkey, somebody pulls the smack away from you, you're going to die. Your body will shut down. This economy has been dependent on free money, easy, cheap money for well over a decade now, since the Fed started pumping massive amounts of stimulus money into the market, uber low rates, and so it's being taken away too quick, and that's not a good thing for stocks. So, however, okay, so the whole reason the stock market goes down, rates go up, it's bad for stocks, and you might say, well, rates go up, that's going to be bad for bonds. Not necessarily. The Fed raises the federal funds rate, which is an overnight rate banks use, and it's the shortest of short-term rates there is. The 30-year bond, this is looking out 30 years. So if you take Powell on face value that he's going to continue to be an inflation hawk and continue to raise rates until he sees an abatement in inflationary forces, labor wage increases in the housing market and everything else, food, energy. So you take him on face value. That's going to cause a recession. He's made no qualms about it. He said we're going to feel pain. He's willing to push the economy into a recession. A lot of people say we're in one. It's debatable. But what that's going to do is curtail future economic growth. And interest rates, long-term bonds, look out. And it will, if you take him on face value, that he's going to continue to raise rates no matter what it takes till he gets inflation back under control. Well, then long-term rates should be going down. And at some point, I think the bond market's going to realize that you're going to have a combination of inflation no longer being an issue, back under control, at a moderate rate, 2-3% or less. And then you're also going to have slowing economic conditions, which tend to bring long-term rates lower. So and that's the whole point of an inverted yield curve. We've already inverted the yield curve. I could show you. I didn't have this chart queued up, but you can see the 1 to 5, the 210. 2-year Treasury bond is higher than the 10-year. So we've already inverted, and that has been one of the most accurate predictors of a recession. So the bond market's already saying, it has been for a little while, that a recession's coming if we're not already in one. But again, that entails short-term rates going up more, and you can see long-term rates either go up less or actually fall, and therefore that would be bullish. Now, at the end of the day, no buy signal until we break these trend lines. Yield needs to break that trend line on the 30-year yield, and then TLT needs to break that. But we did see a nice recovery today off the lows. Look at this recovery on Treasury bonds. This is TLT. We have we were rallied back almost to break even. We gained back over that's 1.17% off the lows. We're not far from there now. And so uh, you're seeing, some buyers step in, buying the long bonds, and that's where I think I made mention before. I'm favoring TLT, or I use ZB, the 30-year bond futures, as well as IEF, which is the 10-year bond. You can see that one's also kind of closed the gap this morning. Nice rally off the lows. Even the 5 years IEI, you can look at that. But shorter you go down into maturity on the bonds, the closer you're getting to what the Fed is controlling, the short end of the yield curve. And you can see the 5 year hasn't come close to closing today's gap. In other words, how much it dropped down. Whereas, like I told you, in the 30-year, you've come a lot closer. So that's one fundamental reason there. And then at the end of the day, again, I can't say it enough. Wait for that buy signal, and then it, to me, it'll be a more of an aggressive or all-in moment. Not everything in my portfolio, but just a full position into Treasury bonds. Still favoring the 10 and the 10 and 30 year. You can see on TLT as well, you have a pretty decent support forming right about here. That's 95 on the button, I think, 95.08. We'll call it 95. You've got a gap right there, and then the top of the gap, and there was quite a few candles right there. You also have, this is a 60-minute chart, by the way. You have on the 60-minute chart this island cluster bottom. Here's a cluster of candles separated on both sides by a gap. An island cluster is a reversal or bottoming pattern. So as long as this gap isn't backfilled right here, then you have all the makings of a bottom in Treasury bonds on this 60-minute chart. And lately, you've just been kind of going around in this range. This is our consolidation range. So we need to pop the top of that. But if you pop the top, then you're going to pop the downtrend line. So it's all the same. You get a big buy signal right there, and you also break out of this consolidation area here. And I think it'd be a quick rally up in bonds. Okay, so to recap so far, short equities, long Treasury bonds, and also view that as a partial hedge. I mentioned that a couple weeks back. Being short, they've had a positive correlation, meaning one goes up, the other goes. So to be long one and short the other, let's say that correlation continues. So if I'm wrong, the stock market starts to rally, my index shorts go down in value, then the bonds should go up. But if I'm right on my thinking here, I have an indirect hedge, so it could actually work to my advantage. We could see stocks go down and bonds actually rally, or at least fall less. That's what I'm looking at. I think there's a better risk reward being long treasuries right now. All right, next up, let's do cryptos. I'll start with the futures. That would be BRR, Bitcoin futures. It's a 6-month, 2-hour candle. You have a nice clean downtrend here that goes all the way back. That downtrend line starts in May, and you can see it comes in here, and we've been just pushing up against there. Now this crypto has, at times it used to be a risk-off asset considered an alternative to the stock market, but so far this year it's moved in near lockstep with the stock market. It's just more volatile. When the stock market drops, it drops more. When the market rallies, it rallies. But this one still has a constructive chart. I mentioned that a few weeks back. And we continue to put in, we had this divergent low, and we're pushing up against that level. So it is possible to see this one return to a risk off. Right now, we're getting back, the big buzzword for the last few years has been TINA. It's an acronym for there is no alternative, meaning stocks were no good, bonds were no good. But I mentioned, there are some alternatives, and we could see a return to Treasury bonds as a risk-off asset. Stocks continue to do poorly, and we may see crypto finally do what it was, one of the things it was intended to do is be an alternative investment, alternative place to put money. And but again, let's let the charts tell us what to do here. Put a little trend line there, so you have about a small little triangle pattern right here. And you also have horizontal price resistance at about 2,682 right there. So if Bitcoin can pop that, that'd be your next target. Then you'd shoot at these previous highs right here, and then maybe eventually all the way up here. Again, you can view it like the stock market. You can have use it as it's just a way to diversify. It's a completely different asset class. and maybe the stock market rallies, and then Bitcoin goes up as well. Bitcoin probably will go up. Almost certainly will go up. Most likely will go up, I should say, if the stock market rallies. So to be short the equity markets and have Bitcoin as maybe a hedge, obviously you don't want to put as much in, because if it goes down, it tends to fall faster or more than the stock market. And likewise, when the stock market rallies, it tends to go up more. But that would be the futures there. And if you trade, it's in ETF-like instrument. It's not exactly an ETF. It's very similar. And you can see a very similar pattern here. There's the trend line I have right there. Same one I showed you on the futures. And we've gone through it a little. This thing trades at a premium or discount to the price of Bitcoin, so you won't have it tracked perfectly. That's why I like to use the futures. You can use both. Either way, it's, once you get a clear breakout, these are your targets: 1302, 1398, and then that larger downtrend line right there, and maybe eventually all the way up here back to this possible T4. We already hit, it was a trade idea back here. As mentioned, we never went, if that's your target, the final target, we never exceeded more than a 3-to-1 RR, so it's really could be the same trade. You wouldn't have been stopped out if you were using targeting all the way up here to T4. Your stop would have been somewhere down here. And again, so it looks constructive, especially if the stock market rallies, but possibly even if the stock market doesn't rally. At least as of now, it looks constructive. ETHE, Ethereum, 60-minute chart we're looking at here. There was a breakout there. It's been consolidating. These are all potential targets. Needs to pop above that $11, 1101-ish level right there to move up to the next target. That's the 60-minute chart. That's what the daily chart looks like. You have a nice downtrend line right here, and that's a big breakout if that can happen. So that's the setup on Ethereum. Put in a divergent low here and an island cluster bottom, and put in another divergent low more recently right here. Broke out of that little bullish falling wedge, and it's been flagging right here, right on the downtrend line. The futures are ETHUSDRR. It's a whole mouthful. That's the symbol for the Ethereum futures. I thought I had this one marked up. Sometimes these futures roll and then my lines go away. Let me see if I have anything for you on the 3-month. No. All right, let me go back out here. Let me go to 1 year and probably give you a downtrend line. Looks something like that. I'd have to mock this chart up, and it's not right now. But just go off similar to what I just showed you on the daily chart there, if we can get a little more upside. So I'm lukewarm on these, not crazy about them, because of that correlation, being bearish equities at this moment, and the fact that the cryptos moved mostly in line with equities, makes me say that maybe those bullish setups may fail, but maybe not. I don't know, and that's why I like to spread my bets. So I have a small exposure to crypto, nothing big. Plenty of room to add if we get those breakouts and the charts continue to firm up. All right, next up, crude oil. I'll just start out here on the crude future CL. This is a daily chart. This is a decent trend line, not my favorite, but it had enough reactions right there. It's a downtrend line on the daily chart that comes off the, looks like the mid-June, late June lows, or I'm sorry, late June reaction high right there. Not the highs. There was we had a nice trend line there and a sell signal. There was divergence on the 60-minute chart at that point. But then afterwards, we set up this trend line, and the reason I have it here is there's enough reactions, distinct reactions, to validate it, including most recently. So we're pushing on that. Upside break, especially a solid daily close, would be bullish, but then you have another reaction high just above that could stop it. You have some price support down around here, and then you also have this uptrend line. So really what we're forming right now is this, on the daily, is this triangle pattern here. And I'm still favoring more downside in crude. I think the energy sector, it's one of my favorites right now for the S&P 500. I think the sector that has one of the better risk-reward profiles for shorting right now, if you're going to short a sector in the S&P. When you look at crude oil, on the 60-minute chart, we recently put in this divergent high here, i.e. negative divergence. First, you had this small 60-minute bearish rising wedge. You did have divergence on that as well, but it was a small divergent high. You got a sell signal on the breakdown, you walked on down, then you made a marginal new high, which simply extended those divergences, made them even larger, and we're starting to come down off that divergent high. That was also price resistance right there at about 90.31, and that previous reaction high there. And so I favor a move down to at least this trend line. But then on the daily chart, that's that same uptrend line I showed you. So if that breaks, that's going to have longer term bearish implications. If the stock market does get that final swoon down to my fourth target on QQQ, this would probably be the most likely scenario, not guaranteed, but you'd probably see demand, or at least perceived demand destruction for crude, and you could see crude prices drop. Otherwise, there's a lot of shenanigans going on right now with OPEC Plus, including Russia, the Saudis, and obviously not our good friend like they used to be. Not obviously not very friendly with this administration, so that's keeping the price of crude, among other things, high, and not to mention Biden's war on the fossil fuel industry. So that's that. But technicals say, look for these divergent highs, divergent high, divergent high, divergent high, and divergent high, and then swing them short. All right. Next up, natural gas. That was thrown out as a trade idea a week or so ago, a couple weeks maybe. And this is a 60-minute chart. We had a downtrend line right here with a divergent low, bullish falling wedge pattern right there. There was our breakout. We hit the first target right here at 6273. Had a pullback. We've been stair-stepping higher, zigzagging. These are 1, 2, 3 successive lows. They're all higher lows, and so far higher highs up to that point. And so I'm still favoring a move up to T2. Quite often you'll see, natural gas, people think of them in the same context, that they're going to move together because they're coming out of the ground together. It tends to be when they're pumping a lot of crude, you get a lot more natural gas out there. There's more supply. And so, you can see, again, I trade them on their own technicals. There are times where they're both running together, and there are times where one's going up and the other's going down. And so I like to trade them on their own unique technicals. Nat gas needs to take out this trend line, this downtrend line. When it does, that should pop it up to that second and final target. That still remains my final target, T2 up there at about 623 or so. Really nice resistance level if we get there, and most likely, if charts confirm, close long and reverse it for a short for a pullback trade. But first things first, we got to take out this minor downtrend line right there, and there's that first target resistance levels around 627. That would also need to get taken out, of course. And wheat, really no update, nothing new. We bought it recently here at this uptrend line. That's the primary uptrend line off the 2020 lows. Bought it right here on the pullback there. It popped up. I have my suspicions, or pretty little doubt, that Putin, maybe not directly sitting at his desk, but through his minions, probably manipulating and trading wheat futures and on the futures market with all these shenanigans. At first they were going to stop. They backed out of their agreement to let the shipment of wheat go through the Black Sea, and now they're back on it. So it's been moving back and forth, but again, as I mentioned the other day, we didn't take it on the news headlines. We took it on the technicals, and as long as it remains above that level, and really above, there's some price support below around 833, then it still looks good for a swing or trend trade, because the whole thing is we're in a bull market in commodities, and wheat included, and in a bull market you buy pullbacks to support. And if you have a well-defined uptrend line, well, that's what you do, and sooner or later maybe that uptrend line doesn't work anymore, and then we stop buying it. But as of now, that's been the trend, and so this could be the swing possibly to new highs and beyond in wheat. Ultimately, it's not going to go straight there. And again, like anything else, manage your stops appropriately. If you're going for a trend trade longer term, maybe you put a stop below those recent lows. If you're looking for a swing trade for smaller profits, you might want to keep your stops relatively tight. ZW are your wheat futures, which are right here, and you can see just this is all the news driven events lately, but we also took it because of this positive divergence on the 60-minute chart, and that's where we took it the other day right here. So we popped up, hit that first, that 892 and a quarter resistance slash target level, hit it to the button there, pulled back, powered up, had a breakout, but then it failed. But we're still back at entry or above entry right now. And again, we're also at that long-term uptrend line support. So another way to say this, it right now provides an objective entry or add-on right here. And then last but not least, that just brings me to commodities as a whole. Remember, everybody knows it now. I don't care who you are. If you're listening to my voice, you're very acutely aware that we are in an inflationary, some might call it a hyperinflationary environment. If you want to buy inflation, you want to participate in that instead of fighting it, worrying about the cost of milk and gas in your car going up and everything else. Buy commodities. You're in a commodity bull market. Commodities are inflation. We're coming off a long bear market in commodities because we've been in an uber low inflationary environment for a long time. This is DJP. Commodities peaked. Their last bull market ended back in 2008 when we were in the bear market in equities. Then we embarked on an era of unusually low, persistently low inflation, and that's where the Fed figured they could just print. The old school rules of printing money and causing inflation just didn't seem to matter to them anymore, just because it didn't get it right away. So what they did, instead of just continue to print, they printed more and more each time there was a little financial crisis or a little blip in the market or the stock market pulled back. They came in with more until they finally went all out nuclear when COVID hit. A little virus going around, and they just figured they just go crazy. The federal government overstimulated, the Fed overstimulated, and then what they did is finally inflation reared its ugly head. It showed up. So again, this is a bear market in commodities that's ended here in 2020. We've begun by every metric out there, at least in my opinion, a new bull market. We took out all these previous highs right there, and that tells us this is early stage bull market action. And there'll be corrections along the way. And if we drop all the way down here to 3081, that's an objective entry. If we happen to drop there to 2588, the only way, if we start going down below this level here, then hey, maybe this was just some kind of aberration or blip or a very brief bull market. But I don't think so. I think there's a lot more to do. And so think about it this way. Even back here in '08, inflation was relatively calm, right? Right now, we have the highest inflation in over 4 decades. So is it that unreasonable to think that commodities can just return back to where they were in 2008 when inflation was low? Because that's their peak. And if that's the case, again, this is just a general commodities index, then there's another, to get back to where we were in 2008, again, in a low inflationary environment, that'd be another 120% return on top of the so far 161% or so, 170% off the lows. So again, in a bull market, what you do is you buy pullbacks to support. 31, we may or may not get there. If we do, I'll be a buyer of commodities, but I'm also selectively entering commodities, as I explained. I'll go into corn, wheat, coffee, soybeans, crude oil, natural gas at the right times. But for those of you that don't have the time or skill sets to manage a portfolio of different commodities in and out different times, then pick a broad-based commodity ETF or fund, and like this one, and just be aware of what it has. That the one reason I don't do this is because at any point in time I might be short crude oil, and this one has, at least as of last year, this has changed, it's about 10% crude, about 8% net. Well, no, there's WTI crude is 9.18, and then Brent crude is 7.6. So together you've got about 16-17%, or at least back then. Natural gas, you had about 8%, and so you can see it's got a lot of different things in there. And I also noticed yesterday when the stock market and bonds were getting clobbered because they didn't like what Powell was selling, commodities across the board were rallying. Most of them were up yesterday, and again, it shows you that's where institutions are buying and individuals. So again, it's all part of a diversified portfolio. Maybe I'm wrong on the commodities bull. Only time will tell. But investing Active trading, swing trading is just as important to have proper diversification and asset allocation is long-term investing. Asset allocation is how much are you going to put into stocks, how much into bonds or fixed income, how much into commodities, and then there's other asset classes now like crypto, REITs, things like that, and that's a diversified portfolio. So one day when your stock holdings are going down, maybe you're making money on your bonds or your commodities, and you're not all over the place, and then you sleep better at night. And more importantly, you don't freak out and panic out of a position at the wrong time. Because your entire portfolio is down. That's what happens to people that trade only crypto or trade only the stock market or only meme stocks. They tend to have wild swings. The highs are really high. You feel great, on the big up days, and then the down days are really bad. And so that's that. All right, guys, that's the update, and yeah, that's all I really wanted to cover. I don't think there's anything else. Cotton's really not doing much anything different than the last update. There was that trend line. I'd updated this one the other day. And CT cotton futures finally took a while. We were putting in divergent lows, and finally this one stuck. We broke gapped above this minor downtrend line right there, and then also above the primary downtrend line. We back tested it, and we've been stair stepping higher. There is some divergence, but we just broke out of a nice divergent low, and we were very oversold. So often early on in a breakout like this, these divergences will get burned through, and there's an uptrend line in which to buy pullbacks too. But at this point in time, that would be my line in the sand. That's 0.7587. That's or maybe go to the bottom of the gap right there. That would be max stop, also max pullback area where I'd buy. Anything more than that means this breakout failed. All right, I'm going to wrap it up here. This has been Randy Finney with the Right Side of the Chart. Have a great day.